On September 15, 2008, Lehman Brothers filed for bankruptcy, setting off a chain reaction that froze global credit markets. Economic historiography often frames this specific failure as the match that ignited the global financial crisis. The conventional wisdom dictates that massive government bailouts were the only viable response to the ensuing distress of heavily interconnected financial conglomerates. But 6 months prior, the United States Treasury and the Federal Reserve engineered a different outcome for Bear Stearns, providing $29 billion in assistance to facilitate its sale to JP Chase. This action signaled to the market that the government would backstop major institutions to prevent a systemic default. We can construct a macroeconomic counterfactual. What if the Federal Reserve prioritized systemic continuity over political pressures in the fall of 2008? If regulators had subsidized the acquisition of Lehman's good brokerage assets and isolated the toxic real estate assets in a government-backed holding entity, the timeline fractures. By saving Lehman Brothers, the visceral panic that triggered mass withdrawal demands from money market mutual funds is averted. Interbank lending markets continue to function. The Dow Jones Industrial Average avoids its precipitous 4.5% one-day drop. Consequently, the Emergency Economic Stabilization Act and the $700 billion Troubled Asset Relief Program, designed to purchase toxic assets from failing banks, becomes entirely unnecessary. Averting this acute crash erases the necessity for a decade of emergency central bank interventions. This single point of divergence removes the primary catalyst for the asset price inflation that would have defined the next 18 years. The defining legacy of 2008 was the implementation of zero-interest rate policies, a central bank strategy to stimulate the economy by keeping borrowing costs near zero. In a counterfactual timeline without the crash, money retains a tangible time value. This chart compares the actual legacy of the post-2008 era against our counterfactual. Instead of slashing the federal funds rate to near zero, central banks maintain interest rates in a normalized historical range of roughly 3.5% to 4.5%. The actual zero-interest era heavily penalized traditional savings and fixed income investments. Institutional and retail investors were forced further out on the risk curve in a desperate search for yield, inflating asset bubbles across equities and real estate. In our 4% baseline timeline, the risk-free rate of return remains a viable investment strategy. Capital is allocated based on traditional risk-adjusted return metrics, demanding disciplined balance sheets rather than relying on cheap debt refinancing. This sustained cost of capital impacts the technology sector acutely. High-growth startups are long-duration assets. Their valuations are highly sensitive to the discount rate, the percentage used to calculate the present value of future cash flows. A 4% interest rate heavily penalizes companies projecting profitability a decade into the future. This environment kills the viability of blitzscaling, a business strategy prioritizing rapid, massive market capture over near-term profitability. Investors simply refuse to fund perpetual operating losses in exchange for mere user growth. Without an influx of cheap venture capital, the millennial lifestyle subsidy never materializes. Parent companies cannot burn through investor cash to artificially lower prices. Ride-sharing and food delivery services must charge their actual market equilibrium cost from inception. Because consumers must pay the true operational cost, adoption of these gig economy platforms is significantly slower and more organic. They fail to aggressively displace traditional industries like municipal transit or local logistics. Venture capital deployment shifts entirely. Rather than directing hundreds of billions toward consumer applications with dubious unit economics, capital in a 4% environment seeks tangible value creation. Funding flows heavily into deep technology, advanced manufacturing, and critical infrastructure. The artificial intelligence boom of the mid-2020s still occurs within this timeline. However, it operates under rigorous capital discipline. Companies investing billions into computing infrastructure are required to demonstrate immediate commercial viability. By avoiding the distorting effects of zero-interest policies, the hyper-financialization of the tech sector is prevented. Speculative bubbles are replaced by a smaller but significantly more robust and profitable corporate landscape. This chart illustrates the catastrophic sovereign debt explosion triggered by the actual financial crisis. Governments worldwide absorbed the toxic liabilities of the private sector to prevent systemic collapse, causing debt-to-GDP ratios to skyrocket across the developed world. In our counterfactual, governments do not implement multi-trillion-dollar bailout programs or massive Keynesian fiscal stimulus to resuscitate frozen economies. Consequently, national balance sheets remain solvent, with debt-to-GDP ratios for major economies like the US and Japan staying 40 to 50 percentage points below their actual historical peaks. In late 2008, the real-world recession in the West caused a sudden and severe collapse in global export demand, hitting manufacturing economies directly. Beijing reacted to this collapse by announcing a 4 trillion yuan fiscal stimulus package, equivalent to 12.5% of China's 2008 GDP, deployed rapidly through local governments. Because local governments in China are legally restricted from running deficits, they channeled this spending through off-balance sheet entities known as local government financing vehicles. These entities borrowed heavily from state-owned banks to fund redundant infrastructure, sparking an immense real estate bubble.
If the global financial crisis never occurs, export demand remains stable through 2009 and 2010. Beijing is never forced into a panic, and the 4 trillion yuan stimulus is never executed. Without municipal financing vehicles issuing massive amounts of bank debt, China's total social financing, the broad measure of credit and liquidity in the economy, remains strictly proportional to its nominal GDP. The rapid expansion of the shadow banking sector is avoided. Because the state does not forcefully redirect credit to low-productivity, state-owned enterprises, capital access remains open for the highly productive private sector. By skipping the panic-driven stimulus of 2008, China's headline GDP growth over the next decade is lower, but the nation trades debt-fueled double-digit growth for an underlying economic resilience, unburdened by the crushing weight of insolvent local governments in the 2020s. The trauma inflicted by the Great Recession fostered a systemic distrust of political and financial establishments. The perception that financial elites were rescued while wage earners suffered from mass unemployment generated a reservoir of cultural resentment. Our counterfactual timeline avoids the severe economic scarring that drove this resentment. The localized recession prevents unemployment from spiking to the 27% levels seen in parts of Europe. The primary catalyst for anti-establishment voting is neutralized. The lack of acute economic insecurity alters the political trajectory of the late 2010s. Without austerity-driven poverty, the populist backlash in Europe is heavily dampened. The United Kingdom's Brexit referendum is either defeated at the polls or never initiated, keeping the nation integrated within the single market. The centrist neoliberal political consensus also survives in the United States. Sino-American relations remain anchored in economic interdependence, and the U.S. establishment maintains its commitment to globalized trade frameworks rather than enacting aggressive double-digit tariffs. This macroeconomic stability also removes the oxygen from decentralized finance. Cryptocurrency was originally conceived as a direct ideological backlash against the too-big-to-fail bailouts of the conventional banking sector. When Satoshi Nakamoto mined the genesis block of the Bitcoin blockchain in 2009, a specific message was embedded in the code, a newspaper headline regarding the UK Chancellor standing on the brink of a second bank bailout. Without the implementation of quantitative easing, massive central bank purchases of securities to inject liquidity into markets, widespread fears of fiat currency debasement and runaway inflation do not materialize. The core value proposition of a decentralized, deflationary digital currency loses its urgency. Without the systemic failure of legacy banks, public trust and centralized finance remains intact. Bitcoin continues to exist as a niche academic exercise, but the multi-trillion-dollar capitalization of the shadow crypto banking sector never takes shape. The Counterfactual 2026 presents a stable surface. Public sovereign debt is contained, housing prices track closely with organic wage growth, centrist geopolitics remain unfrayed, and capital discipline governs the technology sector. But this stability is purchased at profound structural cost. By rescuing failing institutions, policymakers forcefully suppress the natural mechanism for destroying misallocated capital. The state establishes absolute moral hazard. This is the market expectation that extreme risk-taking carries no penalty, because the government will invariably backstop systemic risks and absorb the cost of failure. In reality, the catastrophic 2008 failures forced regulators to rapidly draft and implement stringent new capitalization and liquidity rules to protect the global system. Because the counterfactual timeline avoids a massive systemic collapse, regulators completely lack the political capital to impose these strict new requirements. Banking lobbyists successfully argue that increased capital mandates would stifle economic growth. This animation shows the regulatory mechanics failing to evolve. The international banking framework remains stuck on Basel II, relying on overly optimistic internal risk models. The stringent liquidity coverage ratio, or LCR, is never adopted. The LCR is a requirement for banks to hold enough high-quality liquid assets to survive a 30-day stress scenario. Nor is the net stable funding ratio, or NSFR. The NSFR is a standard designed to ensure banks have reliable sources of funding over a one-year horizon. Highlight the specific absence of the systemically important banks, or SIB, buffer. An SIB buffer is an additional layer of capital that globally significant financial institutions are required to hold to absorb potential losses without triggering a systemic collapse. By 2026, the global banking sector operates with significantly lower Tier 1 capital ratios. It evolves into an interconnected web of opaque derivatives, relying heavily on inadequate liquidity buffers. This creates a fatal paradox. The lax regulatory environment actively promotes higher short-term lending and economic expansion during the 2010s, but the unresolved risk is pushed entirely into the shadows, accumulating unchecked. Averting the global financial crisis achieves an unbroken decade of macroeconomic tranquility, but the underlying system is operating on borrowed time. Deprived of market discipline and governed by unreformed banking regulations, the global economy relies entirely on the perpetual promise of government rescues, a highly leveraged system vulnerable to synchronized insolvency across its most critical financial hubs.